Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Black Hills Corporation Annual Report. Black Hills Corporation operates as an electric and natural gas utility company in the United States through its subsidiaries. The company's services can be categorized into several key areas. The electric utilities segment of the company provides electricity to customers in 4 states: Colorado, Montana, South Dakota, and Wyoming. This includes generation, transmission, and distribution of electricity, as well as ownership and operation of power generation and mining assets. Additionally, excess power is sold to other utilities and marketing companies. In contrast, the gas utilities segment focuses on natural gas distribution to approximately 1.14 million customers across 6 states: Arkansas, Colorado, Iowa, Kansas, Nebraska, and Wyoming. This includes ownership and operation of interstate gas transmission pipelines, gas distribution mains, service lines, natural gas storage sites, compression facilities, and gathering lines. Beyond regulated services, the company offers non-regulated services to its retail customers. These include Service Guard Comfort Plan, which provides home appliance repair services through monthly agreements; Tech Services, which offer construction and maintenance of customer-owned infrastructure facilities, as well as electrical system construction services; and Home Serve, additional home repair service plans for natural gas residential customers. Furthermore, the company produces electric power through various sources including wind, natural gas, and coal-fired generating plants. It also operates a coal mine in Wyoming to support its energy production needs. The stock price of Black Hills Corp. BHC has increased by over 25.78% in the past year due to several key news events and positive developments. The company reported robust full-year 2025 results, with a 5% increase in GAAP earnings per share and an 8.57% rise in total revenue. This strong financial performance was bolstered by ongoing customer growth, data center demand, and new rates. In addition to its financial success, Black Hills Corp has made significant progress on strategic infrastructure projects, including the completion of the Ready Wyoming Electric Transmission Expansion Project. The company has also expanded its data center pipeline to over 3 gigawatts, with growing demand expected to contribute over 10% of consolidated EPS starting in 2028. Favorable regulatory outcomes have contributed to stable revenue and earnings growth, while analyst upgrades and raised price targets have further boosted investor confidence. The proposed merger with Northwestern Energy is also seen as a strategic move that could support a 5-7% EPS compound annual growth rate, CAGR. Overall, the combination of strong financial performance, strategic execution, and market sentiment has driven the notable increase in Black Hills Corp's stock price over the past year. Black Hills Corporation maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Black Hills Corporation trades at a higher price-to-earnings ratio of 18 times and a lower price-to-book ratio of 1.45 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 64% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 3.87%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be categorized into common drivers that affect multiple industries and company-specific factors unique to individual businesses. Regulatory environment changes, market conditions, hedging activities, and commodity price risk management are the common drivers that significantly impact revenue. For instance, fluctuations in market prices and demand can affect revenue, while effective hedging strategies can mitigate risks and increase revenue. Companies that effectively manage commodity price risks through options, swaps, and other derivatives can reduce volatility and increase revenue. Industry-specific drivers also play a crucial role in determining revenue growth or decline. Electric utilities experience revenue growth due to regulated electric utility operations, non-regulated power generation, and mining businesses. Gas utilities see revenue growth from regulated natural gas utility subsidiaries in various states. Company-specific factors further contribute to revenue growth or decline. Black Hills Corporation's consolidation of captive insurance, non-controlling interest in Black Hills Colorado IPP, and changes in market conditions have impacted its revenue. Other companies experience revenue growth due to proceeds from ATM programs, natural gas price volatility, hedging activities, state regulatory commission guidelines, and rate recovery. In conclusion, understanding the primary drivers of revenue growth or decline requires analyzing both common industry-wide factors and company-specific circumstances. The net income and profit margins of the company underwent significant changes between 2024 and 2025. Initially, there was a 5.7% increase in net income by $16.1 million from 2024 to 2025. However, this growth was offset by a decrease of $2.4 million due to lower net income from Black Hills Colorado IPP, primarily driven by unplanned generation outages. In terms of profit margins, the operating income margin decreased by 0.4% from 2024 to 2025, while the net income margin declined by 1%. On the other hand, the gross margin, GAAP, for electric utilities increased from $329.1 million in 2024 to $323.4 million in 2025. But the electric and gas utility margin, non-GAAP, decreased. The changes in profit margins can be attributed to various factors, including a decrease in net income from Black Hills Colorado IPP and an increase in net income due to consolidation of captive insurance. Additionally, profit margins related to cash flow hedges decreased, while those related to defined benefit plans increased. Overall, the company's net income and profit margins experienced fluctuations between 2024 and 2025, with some areas showing growth and others decline. The company's debt level and interest expenses have undergone significant changes over the past few years. According to the extracted summaries, the total debt level has increased from $4,384 million in 2023 to $5,292.1 million in 2025. With a notable increase of $847.2 million between 2024 and 2025. Long-term debt has also seen an increase, rising by $450.9 million from $4,250.2 million to $4,701.1 million. In terms of interest expenses, the picture is less consistent. While some pages indicate a decrease or slight increase in interest expenses, others show a more significant rise. For instance, net interest expense increased by $18.4 million on page 45, while interest expense decreased by $18.4 million from 2023 to 2024, and then increased again from 2024 to 2025. Overall, the data suggests that the company's debt level has indeed changed significantly over time, with a notable increase in total debt and long-term debt. However, the changes in interest expenses are less clear-cut, with varying trends across different pages. The performance of various regions and segments in the energy sector has been mixed, with some showing significant growth while others struggled to keep pace. On the positive side, South Dakota Electric and Wyoming Electric have seen substantial increases in electricity generation, with 1,758.1 GWh and 1,637.1 GWh respectively in 2025, up from previous years. The industrial segment has also experienced a notable surge of 18.7% growth from 2024, while the commercial segment saw an increase of 6.1%. Additionally, Nebraska Gas and Colorado Gas have added significant numbers of customers, with 2,285 and 3,950 new customers respectively. However, not all regions have fared as well. Colorado Electric has seen a decline in electricity generation, from 865 GWh in 2024 to 742.4 GWh in 2025. Wyoming Electric's heating degree days were 6% below normal in 2025, which could impact energy demand. Arkansas Gas and Kansas Gas have also struggled, with revenue decreases of $38.3 million and only a modest increase of $30 million respectively. Furthermore, the Colorado region is facing new or more stringent regulations that may require significant additional costs. Overall, while some regions and segments have shown strong growth, others are facing challenges that will need to be addressed in order to maintain competitiveness and meet future demands. Management is emphasizing the company's commitment to a sustainable future by shifting its focus towards renewable energy. The company has already made significant investments in wind energy through its joint ownership of a 52.5 MW wind farm. As the global energy sector transitions from fossil-based systems to renewable sources, management expects fluctuations in customer usage due to various conditions. However, these changes also present opportunities for growth as customers increasingly opt for renewable energy. To adapt to changing load demands and improve distribution systems, the company plans to invest in infrastructure and operational improvements. Management is confident that this strategic approach will enable the company to recover future increases in income taxes payable through probable rate revenue increases. The company's outlook is centered on generating new annual revenue from rate increases in various states, while supporting its business growth using cash generated from operating activities and financing alternatives. Overall, management's vision for the company's future is one of transition towards renewable energy sources, driven by a commitment to sustainability and customer needs. The company has made several strategic moves through acquisitions and divestitures to shape its portfolio and operations. In terms of acquisitions, the company has purchased the Gillette Energy Complex, a battery storage facility, as part of the Colorado Clean Energy Plan, and proposed a merger with Northwestern in an all-stock business combination. Additionally, BHC acquired Northwestern's common stock, consolidating assets and liabilities. The divestitures made by the company include the exit of its exploration and production business in 2018. These moves demonstrate the company's efforts to adapt and evolve its operations to meet changing market conditions and priorities. The company has a history of paying dividends to its shareholders. This is evident from various sections in the provided documentation, including page 40 and page 52, which explicitly state that the company has paid dividends. Furthermore, page 55 and page 72 provide specific figures for dividend payments made in 2025, totaling $197.9 million. Additionally, page 111 confirms that the company has indeed paid dividends, as stated under the Dividends/Buyback Summary section. Concerns about inventory buildup or supply chain disruption are indeed valid. The freight system is vulnerable to disruptions, which can lead to delays and increased costs. Furthermore, the imposition of new or increased tariffs or quotas can also cause supply chain issues. Environmental threats such as weather-related disasters, rising demand for key materials, and geopolitical unrest can further exacerbate these problems. Moreover, the lack of availability and cost of natural gas is another concern that could impact supply chains. Disruptions in the delivery of natural gas due to various factors can lead to shortages and increased costs. These challenges can negatively impact operations, making it essential for companies to be prepared and adaptable to mitigate potential disruptions. That concludes the financial summary for Black Hills Corporation. Feel free to comment below, and I will be happy to answer them when possible.